What is inheritance tax? How do people avoid it? And what should we do with the possibility of a change in government that might have more interest in capital taxes? And it also gives us a nice deadline to work towards, because it's very difficult to get a sense of purpose with inheritance tax, because we sort of think the inevitable will never happen. So getting a clear deadline gives urgency to it. I do regular updates on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel, and if you press the like button, it helps me in the channel, so thank you for that. So inheritance tax. Inheritance tax is a tax on your assets after you've died. It's set at 40%. So once your assets are in play for inheritance tax, the tax is actually very high, and people particularly don't like it because it's tax on money that's already been taxed, potentially at higher rates already. So the government have had like their 45% tax or more, and now they're owing another 40%. What is going to be left? This is assets that you've taken a lot of time and care and diligence to build, and you don't want the money just to go to the government. So first of all, yeah, it's set at 40%. The limits are the first 325,000 that you give away on your death is tax-free, and then there's another allowance of 175,000 on your main house, as long as your total assets are less than 2 million, after which it is tapered, and as long as you give that part of your house to your descendants. So that's children, stepchildren, grandchildren. So the 175,000 plus the 325,000 is 500,000. And then on top of that, for a husband and wife, then when the first person dies, if they give everything to their spouse, then that spouse also inherits the allowances, so everything is doubled. In effect, you can have up to £1 million. And that inheriting goes on even if you remarry. So if you've been in a long marriage, you've inherited somebody's allowances, then you remarry, you still have those inheritance allowances. So those are quite big allowances. But after it, you pay this 40%. So if you've got £2 million of assets, then your heirs are going to pay £400,000 of tax, which is a great deal of money, and they will be having to sell stuff in order to meet that liability. And if it's in property, they may have to remortgage the property, or they may have to sell the property. That's why people don't like it. So let's deal with the little things. So you can give £3,000 a year to anybody, one lot of £3,000. You can give £250 to everybody, but obviously it's not very much. And that £3,000 and that £250 have been stuck the same for ever since I was a child, I think. So they've been devalued by inflation. I think you can also give £5,000 on somebody's wedding. But more importantly, you can give small gifts out of income. So if you've got a reasonable income, you can give gifts out of that income, and they're not included. So the gifts could be more than £3,000, as long as it's out of income, because inheritance tax is intended to be a capital tax, not a tax on income. So those are the small things. It's sort of jokey, but it's not really. So the best way to avoid inheritance tax is just spend the money. And you can spend it on your family and with your family and enjoy it. And that is one way of avoiding inheritance tax, just spending the money. And although it's slightly facetious, it's not entirely. There's then the 7-year rule, which most people know about. So if you give large amounts of money to a relative or a friend, and then you live 7 years, those are not included in your estate for inheritance tax, and therefore by implication, if you don't live 7 years, there is an implication on your inheritance tax. The way that works is you give the gift, you live 3 years, so if you die within 3 years, it's just included in your estate. Then from 3 to 4 years, you only pay 80% of what you would pay, and then another year and it's only 60%, and it goes down, so it's tapered over. So it's not, you don't have to live the whole 7 years to get the benefit. If you live 6 years, you get most of the benefit. Which means that if you're reasonably elderly, you can still give gifts and it can still be worthwhile. And you can get insurance to cover the gap. So if you're in reasonable health, and even if you're reasonably old, you can cover the potential for inheritance tax, and therefore you pay an insurance policy and not the tax. Another big thing that people do is pensions. So pensions are not truly your assets. They're held in trust for you to provide a pension, and therefore they're simply not included in your estate. So pensions you can pass on to your children, and a lot of people use other assets instead of their pensions, leave their pensions for reserves, and therefore the pensions can simply go to your next of kin like a family trust fund in effect. The one thing about pensions is that the government changes the rules on pensions from time to time, so you just need to be aware of that. So the other big thing is business property. So business property is not a taxable asset. It does count towards that 2 million that I talked about earlier, when you get the extra allowance for your main house. But business property is not taxed. And business property is written quite widely. So yes, it's a family company, but it can be shares held on AIM, it can be some shares held in private companies, as long as you hold them for 2 years. And I would suggest, if you're going down that line, first of all you need financial advice, because the risks might be going up, and because there's no point in saving the tax but losing all the money, and also you just want to make sure you comply with the rules. Just as giving money away works, also leaving money to charity also falls out of inheritance tax. People use trusts. So trust can be good, because trust, when you create the trust, it does create an event for inheritance tax, and it can be taxable. But then you can also be setting the 7-year rule working. And the problem with trust is that once you put the money in trust, you can't then use it for yourself. It can be particularly useful if you've got relatives that you don't trust with the money, you want to control the money, or if it's for people who are too young, like grandchildren, too young to take charge of their own money. The other thing I would just be careful about is overseas assets. So if you've got a holiday house in Spain or in Portugal, in France, then just be careful with those, because you might be subject to inheritance tax in that country, and also you might be subject to the inheritance rules in that country, and continental inheritance tax rules tend to be very different to UK inheritance tax rules. They're more prescriptive. So if you've got a large property portfolio, you can have this problem. It's difficult to give the assets away, because if you give an asset away, it's a capital gains tax event and a stamp duty event, and those two taxes can be almost as bad as the inheritance tax. And at the point of gift, you're no better off for inheritance tax, because you've made a gift and that 7-year rule is going, so you pay all this tax up front, and there's no guarantee you've saved any inheritance tax. Well, it is a real problem, and you have to have the cash to be able to do it. And I would, again, perhaps you should be looking for advice. One way that you can do it is to draw down borrowings from the property portfolio, give the borrowed money to your next of kin, but then it does mean that you've got to service a debt, and taking on a debt in later life, is that really what you wanted to do when you spent your whole life getting rid of debt? It feels wrong, but it can be very useful, particularly if you've, it's about taking chunks out of that inheritance tax, perhaps. Inheritance tax, it's quite a big tax for those that pay it, but people pay it very infrequently. It is something that people worry about, particularly older people, and if I was going to be facetious, perhaps particularly children of rich parents. So there are a number of ways it can be got around. I would suggest you get your ducks in a row before any change of government, and if you need any help on it, I really would take this just as a guide, and then if you want to take proper advice on it, then come in and we can talk about it. I do regular updates on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel, and if you press the like button, it helps me in the channel, so thank you.